Hello, everyone. Today on the Final Bar, it's Wednesday, March 29th. I'll be talking with Callie Cox of eToro. We'll talk about this market pushing back to the upside, the S&P powering above 4,000 yet again. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. It is such a pleasure to be back live with you today. Thanks so much for being patient, and thanks to my guest host, Julius DeKempeter, stepping up yesterday and hosting the show with a great conversation with Brian Shannon. By the way, if you missed that one, I would certainly go back and check it out on StockChartsTV.com. Today, we're going to talk about this market, which in some ways has been range bound, I guess in most ways, right? With sort of this 3,800 to 4,100 range continuing to show this equilibrium. If you look at where the S&P is now, it's the same place it was 1 week ago. It's the same place it was 1 month ago. It's the same place it was 10 months ago. But with all these different narratives, all these different things that have happened between then and now. So what evidence can we get about the future market direction or anticipate the future market direction by looking underneath the hood? This is where we can start to look at sector and thematic leadership, where we can look at breadth and sentiment indicators. So today we're going to dig into some of the breadth indicators to help us understand what is driving the markets around, and also focus on sentiment, which shows how volatility is actually coming down as the S&P is pushing back above 4,000. We have a great guest today, Callie Cox, joining us for the first time. So we'll see what charts and what themes are top of mind for her in a little while after our market recap. But let's get right to it and talk about what happened with the markets today. We're going to start with a poll, by the way, and we always have a poll going on our live stream page at StockCharts.com, also on our social media accounts. So make sure you follow us on Twitter, check out our YouTube channel as well. And we asked you recently about candle patterns. This is the scenario. We have a big down candle and then an up candle, and the second day closes about 75% of the way up the first candle's body. What pattern is that? If you could translate my verbiage trying to explain what a candle pattern looked like, you're absolutely right. 64% of you that said a bullish piercing line. That is the correct name for that pattern. The other three are also important candle reversal patterns, but not exactly what I described. Now, what I will tell you about candle patterns is they are important, I think, not as much in terms of the names of the patterns, but in terms of what they represent. So when you have a downtrend, you have a big down day and then a big up day, and you engulf the previous day's range, that's called a bullish engulfing pattern. If you don't quite get above the previous day's range, that's called a bullish piercing line. And either way, it tells you that we've rotated in the short term from bearish sentiment to bullish sentiment, and it suggests a short-term reversal to the upside. By the way, on the StockCharts platform, we have the ability to scan for some of those candle patterns. On our website, if you go to Charts and Tools, on the right side, there's this little section that says predefined scans. And if you clicked on that, we have a bunch of predetermined technical scans, some that our users and members have used for years and years. There's a whole section on candlestick patterns. This is a great way, by the way, to learn more about those patterns and see live examples of what they look like and think about what that might tell you about the sentiment going forward. So make sure you check out our predefined technical scans for sure. Let's continue on with our market recap, talking about this market environment today, and then we'll connect today's movement with more of the bigger picture. The S&P closing back above 4,000 today. That's notable. I would say 4,100 is a pretty important level. That's certainly getting above the swing highs from the fourth quarter, getting nearer the February high around 4,200, and suggesting more of an accumulation phase. Again, an uptrend is a pattern of higher highs and higher lows. So if we can push above resistance, that's encouraging. The S&P making some headway along those lines, closing just below 40.30, and that's up 1.4% from Tuesday's close. The NASDAQ, by the way, up 1.8%. And the mid-cap and small-cap indexes all up as well. The VIX, by the way, is moving down, and it's actually back below 20. It dipped below 20, I think, on yesterday's session, continuing to push lower. So it's so interesting. Before I went on vacation about a week ago, we saw that the market was chopping around and volatility was spiking. This is around the whole, sort of mini financial crisis that the market appears to be telling us is now in the rearview mirror because we're settling back down with the market moving higher on lower volatility. I don't know if that's the long-term trend just yet, but I'm certainly for now seeing the market moving higher with lower volatility. Interest rates overall, not too much of a change from yesterday. 10-year yields about the same from where we closed on Tuesday's session, around 357. And you can see that bond prices moving lower just a bit with the TLT down about 0.2%. The dollar index moving higher. And one of the interesting sort of themes that we've been teasing out over the last week is this weaker dollar, right? At times we've seen over the last 12 months, strong dollar and weak everything else. This has sort of been that risk off sort of feel to the tape, which we've seen certainly a lot of 2022. We're seeing the opposite here at times where we're seeing weaker dollar here in the short term. And that's giving room for risk assets like the S&P, the NASDAQ, cryptocurrencies certainly going to the upside. Commodities mixed with gold prices down about 0.5%. That's using the GLD, and oil prices down as well. Cryptocurrencies, on the other hand, all in the green. These are the top 10 coins that we track on our StockCharts platform. You can see Bitcoin pushing well above 28,000 through the course of the day today, currently around 28,440. You can see Ether above 1,800. So you're seeing follow through to the upside on some of those cryptocurrency markets. A lot of those certainly pretty volatile compared to equity standards. However, the net movement has been sort of positive with Bitcoin nearing that 30,000 level. And if you think that's important, that's because you've looked at the chart and you've seen that with the chart of Bitcoin with Ethereum, big round numbers, as silly as that might sound to you, often have meaning. And I would argue because a lot of people think of those big round numbers as times to reflect on whether or not the asset is worth that particular amount and whether it deserves going above or below that particular level. So 30,000 may be an important level to watch for sure. Let's check in on the daily chart of the S&P 500. This is my daily chart. I'm going to talk to today's guest, Callie Cox, looking at her chart of the S&P and just thinking about some of the levels and patterns that she's paying attention to. For me, we've talked about this range-bound market. I have these shaded areas indicating 3,800. That was the low from late December. That also happened to be the low from early March. So again, I think the market has memory. Support and resistance levels happen because people use those levels as a way to gauge what may be coming next and anticipating support and resistance. We can see the S&P's bounced off that 3,800 level a number of times. It's actually a Fibonacci level from quite some time ago. We've been talking about for a while. We first talked about it back here in May of last year when the market sold off of the January 2022 highs and found support there for the first time. So once again, that has served as support. So generally speaking, we're above 3,800. Conditions are not that bad. We start to break below there. That's when I think you need to engage the likelihood or embrace the likelihood of further downside targets, right? Support levels are meant to be focused on. And then once those are broken, once those levels don't hold, that opens the probability or opens the possibility for further movement in that direction. On the upside, you can see 4,100 was a level we first tested in November and December of last year. I would argue that the move higher in late January into early February was a retest of that level that broke above it for a couple of days and then fizzled back and rotated lower. So can we get out of that blue shaded area and move to the upside, or do we break below support at 3,800? I would argue the chart is still range bound, right? We're in that painful third direction. We're not going higher. We're not going lower. We're going sideways. So the question is, what catalyst would cause us to break through there? If you asked me a week ago, I would say, we've had some bank failures. I would not be surprised if there's more of that and if there's more sort of ripple effects, and maybe there will be, we just don't know it yet. But for now, the market is sort of shrugging those concerns off and the uncertainty turning more into renewed confidence with the market moving to the upside. Having said that, let's look at what sectors and themes are actually on the move today. You can see real estate, technology, consumer discretionary, the top three sectors today. So while the market is indeed moving higher, the NASDAQ leading the way, REITs, a fairly boring defensive sector, actually at the top of the return list. All 11 sectors ended up in the green, but healthcare just barely got above there. After that, it's consumer staples and communication services, which are the three bottom performers through the course of the day today. In terms of groups that are actually working, a lot of the top 10 stocks in the S&P 500 were in one group, and that's the semiconductor industry, right? We look within the technology sector, which has certainly been a strong performer over the last 6 to 8 weeks. Semiconductors have been some of the best. And if you look at the SMH, you can see it's up over 3%. That one-day move is impressive. What's more impressive to me is that it is above 2 upward sloping moving averages, the fact that the momentum is strong but not excessive, which represents better buying, and the fact that the relative strength has been fairly robust over the last 6 months. This is a leading group with strong technical characteristics in a leading sector, and it's showing strong relative strength, which tells you it's outperforming the rest of the benchmarks. Now, charts like NVIDIA, like RMBS are charts that have been fairly consistently strong. What's interesting about semiconductors today, it's some of the laggards within that group that are actually bouncing higher. Intel up 7.6%, Micron, MU up over 7%. We've got some earnings news that is allowing these names to move higher. Micron pushing to the upside, gapping higher, for now closing right at resistance that we've been testing for quite some time. So while Intel actually breaking out a little bit, I'd be very curious to see if a chart like Micron can actually power above that resistance that we've seen over the last 6 months. As we've talked about many times on the show, strong charts don't just trade to resistance, they trade through resistance. So seeing if Micron can continue not just today's gap, but actually follow through to the upside through the remainder of this week, I think could be an important measure to look at. Just to finish off, let's look at a couple measures of market breadth. I'm going to start with the McClellan oscillator. This is a technical indicator created by Sherman and Marion McClellan years ago and is basically derived from advanced decline data. The very basic back of the envelope measurement using this chart. When the McClellan oscillator is above 0, strong breadth to the upside. When the McClellan oscillator is below 0, it's negative breadth. I've shaded in green and red when the indicator's been above and below 0, and you simply need to look at the bottom to see what the S&P has done when the McClellan oscillator has been bullish or bearish. So the fact that it was bearish starting the first week in February suggested we're in sort of a risk-off mode, certainly in the short term. Look at what's happened in the last week, though, as the McClellan oscillator has rotated back above 0. This suggests, for the most part, that we're probably back into at least a short-term rally mode. Now, it's not just the McClellan oscillator. You also see that in indicators like the bullish percent index. This is a measure of market participation using point and figure charts. You can see that we went below 30%, which told you less than 30% of the S&P members had a bullish point and figure chart. That changed. And you can see with these highlighted areas that I'm indicating over the last year, every time we've gone below 30% and back above, it's been at the very least a bit of a rally phase for the S&P 500. Some of these breadth indicators starting to turn from more negative to more positive. Folks, let's take a quick commercial break. We'll be back with Callie Cox from eToro. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close. And it's a pleasure to put on this show for you every weekday. A couple quick announcements before we bring on today's guest. Callie Cox from eToro. First off, we want to remind you our mailbag is always open. And one of the great parts of the show every Friday and Monday are answering your questions as you are trying to apply the technical toolkit to the market environment. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We would love to hear from you. Hope to answer one of your questions live on the air on Friday's show. Our upcoming schedule, we have a really good guest today with Callie Cox, so we'll talk to her here in a few moments. Tomorrow on Thursday, March 30th, we have Dave Landry, the founder of DaveLandry.com, trader, expert in equities and cryptos. We'll see what charts are top of the mind for Dave. Next week on Tuesday, Chris Shivako. Chris is the Chief Investment Officer of Shivako Capital Management based in Atlanta. He's a longtime StockCharts user and actually is one of those people that when I see him use our charting platform, I try desperately to borrow some of the things he's using because I think he really is able to put together some great charts that tell the story of long-term evolution of these markets. So make sure you tune in next Tuesday, April 4th for that one as well. I want to welcome on today's guest, Callie Cox. Callie is the U.S. Investment Analyst at eToro, coming to us from Charlotte, North Carolina. Callie, it is such a pleasure to meet you and welcome to the show.
Dave, thank you for having me. I'm so honored to be here.
I've enjoyed getting to know your work here recently, preparing for our discussion here today, Callie. And we're starting with the market. I mentioned in our market recap, sort of in an equilibrium, right? We're sort of in this consolidation phase. And the question is sort of what's next? When you're looking at a chart of the S&P 500, thinking about where we've come from, what's next in your mind?
Yeah, so it's funny that I'm saying this right now after a few weeks of banking woes, but it does seem like we're in a consolidation phase. I mean, if you look at this chart right here, I believe the blue line is the 50-day moving average, the red line is the 200-day. And for the past 7 days up until today, we've been stuck pretty firmly in that range, which has come to a surprise for, many bulls and bears, both watching the market and wondering, just what the heck is going on, everything moving around us, but the market not moving too much. And I really think that it all boils down to technicals being the certainty that people are grasping for. And, they see these patterns on charts and they decide to trade off of them. And then suddenly you have a market following technicals.
And it's so interesting. I know in one of your recent notes, Callie, you're talking about how the 200-day moving average is a pretty important barometer. We broke above there really the first time in a long time in January. But from there, we sort of fizzled out. Why is the 200-day an important level to watch for you?
So the 200-day has really stuck out in my mind, Dave, because in past bear market recoveries, when the S&P has fallen 20% or more and then rebounded up, that 200-day moving average has been the line in the sand between most bear market rallies and the true beginning of bull markets. I think the only time since 1950 that the S&P broke the 200-day on the way up after a bear market and then fell to new lows was in 2002, and that was a pretty quick process. It took like maybe 2 weeks for that to happen. So when the S&P broke the 200-day, it was encouraging in my mind because it has been that line in the sand for so long. But now it seems like it's a gut check line of sorts, a line that investors are gravitating back toward because they're not really sure where the market should move next.
It's so interesting when you think about how the market is sort of consolidating. We're certainly seeing strength in the last week here, Callie, but I guess if you asked me a week and a half ago, we're going to have a couple banks go under, a big European bank's going to get taken over by another one. The fact that the market would kind of be slowly drifting higher would not be the main scenario I'd probably envision. Are you surprised by how resilient the market's sort of shaken off all the negativity it felt like was emerging about a week ago?
Well, I'll say I am surprised. Stepping back and thinking about all these factors at play, and I am a fundamental analyst by heart. I think that there's a lot of dissonance going on here. I think that there is a lot of nervousness in this market, a lot of panic. You can see it in moves outside of equities and within the composition of this market rally that we've seen in the stock market. This has been more of a defensive rally, and I think there's a lot of momentum following here too. Just people trying to find clues for where the market will go next. So I'm a bit surprised, but if you look underneath the surface, a lot of the action we have seen has painted more of a defensive picture.
It's really interesting. Your second chart, if we can get to it, is looking at large caps versus small caps, which an incredible change of character of the chart with the last, in the month of March, just moving to the upside very quickly. What does this tell you about sort of the conditions underneath the hood here?
Yeah, so a full disclosure, Dave and I pulled this up before our spot, and Dave calls it a hockey stick chart, and I completely agree. I mean, this chart is stunning to me, but it shows that large caps, larger stocks, even the mega cap stocks, like the top 10 stocks you were talking about, Dave, have taken in a lot of cash over the past, 2 weeks or so. And I think that's another sign that we're in a defensive type rally. When interest rates are high and fundamentals are changing quickly, people will rush to safety, even if we see broader market prices go up. And that's exactly what we've seen over the past 2 weeks. We've seen people gravitate toward those bigger stocks with bigger cash hoards and stronger balance sheets. And they have been across sectors. I've seen a lot of questions around big tech and if it really is a defensive sector now. I think there's an argument to be made that that's the perspective there. But we've seen a lot of safe haven rush into bigger stocks with more proven financials, and that's why you've seen this big difference between big and small stocks. I'll add too, this is probably not what you want to see if you think we're in the midst of an economic recovery, because technically or typically, when we see early bull markets, you tend to see small caps lead.
I was going to say, so I have a chart which I years ago called risk on versus risk off, and it had the relative performance of the IWM, the small cap ETF, and it's certainly not working right now, as your chart sort of illustrates. I'd love to pivot to a couple different markets if we could, and just talk about some of those scenarios. You talked about big technology. Some of the semiconductors certainly have been, arguably one of the stronger parts of the market. When you're looking at a period of uncertainty, when you feel this defensive leadership sort of emerging, are semiconductors or sort of, I guess, what you might call defensive tech, is that the type of place where you would start to look, or where would you look opportunistically to try to ride out a period of uncertainty?
Well, at this point, I think it makes sense to grab a barbell. Look at a barbell strategy here because lots of things are changing at the moment. We're not sure, how far these cracks in the financial system can spread. So, right now, strategically, we're thinking about that defensive part of the portfolio. But considering we're in a period of high inflation and no matter if this is not a good storyline or not, a potential slowdown in growth or recession could solve that low inflation problem. We think it makes sense to have some exposure to quality risk as well. And I also think it goes back to uncertainty too. It is really hard to get overexposed in either direction in this market. I mean, we mentioned a minute ago, we just saw three banks fail and one bank in Europe get taken over by the other, yet markets haven't really flinched. It is extra, extra hard to predict daily and weekly price moves in this market. So we're trying to encourage our customers not to step too far on each side of the ship.
It's interesting when you mention inflation, which certainly has been, I mean, arguably the story, right, for quite some time. I think if you told either of us early 2022, the market's going to be in a raging bear market phase, inflation will be the main reason, I would probably say gold makes a ton of sense. Buy gold, just relax. Gold has been kind of a non-factor for quite some time, but all of a sudden just really starting to reemerge. Do you think that this is potentially now an opportunity where a safe haven like gold actually plays out as a safe haven we might have always wanted it to be?
Well, it's interesting you asked that because we do have banking fears on the front lines right now, but we also have the debt ceiling debate still happening kind of behind the scenes for investors right now. And if you go back to 2011, if you see what outperformed around, the summer of 2011, right before the debt ceiling deadline, gold was one of those big outperformers. So I think it's really tough. I mean, gold is going through a transitional phase right now. It's hard to know just exactly what the market thinks of it or how the market treats it. But if you are looking at a safe haven and you are, trying to think of places to preserve value, then, maybe you have a good argument for gold at the moment with all the fear swirling around.
When we were talking about the S&P 500, Callie, thinking about sort of the bear case, right? Overall, it seems like we're sort of holding in there. We're sort of in this equilibrium phase. While I feel like there have been plenty of potential catalysts to move the market lower, we really haven't seen any sort of follow through. What would the bear case look like for you? And what I mean is there a certain level, a line in the sand, or some sort of event that would occur that would tell you, okay, this is now risk off mode. And while we have been in equilibrium, that equilibrium now seems to be broken. What would you look for that would sort of confirm a likely bear scenario in your mind?
So for me, the bear scenario is a recession, and I'm talking actual recessionary evidence. We see the job market breakdown, which is a very real scenario that can happen from what we're seeing in the banking sector right now. I think that the toughest part of these past 2 years is that we have seen parts of the economy look recessionary, like the housing market, for example, but we just haven't seen the job market flinch. So I am super focused on the job market right now, unemployment claims, hiring, wage growth, if wage growth goes in the right direction, just to really gauge the strength of the consumer right now, because consumer spending is 70% of the economy. And as long as consumers are spending a lot of money, it's really, really hard to have a recession or that breakdown in company earnings.
So, Callie, I already have to thank you for letting me go kind of anywhere and everywhere. I asked if we could, and you very kindly answered my questions. I'd love to finish off if we could, then just thinking of course, the Fed has been, top of mind for a lot of investors. Events over the last couple of weeks it certainly have changed the trajectory of what the Fed may have been planning. But now we're sort of seeing, 10-year yields sort of stabilizing. We're seeing value-oriented parts of the market struggling on a relative basis so far year to date, while growthier sectors are tending to do a little bit better. What do you see next for rates as you look forward to the Fed through the course of this year? What does the level of the 10-year mean for equity investors?
Well, so when we're talking about rates, it's important to distinguish between short-term and long-term rates. In terms of where the Fed is going to go when I'm thinking about short-term rates, I think the Fed is going to have a really hard argument for raising rates from here, especially if we see these banking fears unfold even more. And that affects the shorter end of the curve. So, I mean, right now, the 2-year yield is kind of pricing that in. Markets are looking for rate cuts over the next year or so. I don't think it's as obvious as people think that we're going to get rate cuts, but I certainly don't think the Fed has much reason to get more aggressive here. I think they have a big argument to wait it out. And when you go across the curve, when you think about the long-term side of the curve, the 10-year yield, I mean, that's your recession indicator right there. And we're seeing people pile back into bonds because there are worries about the economy at this moment. So, if you believe in that, if you believe that growth is going to slow because of these recent banking headlines, then I think you have a good argument for rates going lower.
Callie, this has been such a pleasure to talk with you. I really appreciate you answering questions and putting things into perspective. Stay safe and be well in North Carolina. We'll talk to you again soon.
Thanks for having me.
That's Callie Cox. Callie's the U.S. investment analyst at eToro, coming to us from North Carolina. Really love that sort of brief and wide-ranging discussion, touching on a number of different aspects of the market. What I love about how Callie described it is it's connecting what we talk about often with the charts and looking at key levels and key patterns with all of these competing narratives, right? And thinking about how the relationships between rates and the dollar and commodities are all sort of tied into one another, what it means at the end of the day for your ability to manage risk versus reward. A great take there. And I love those thoughts in particular about the chart about large over small. That was a brilliant chart from Callie Cox at eToro. We have to wrap the show, folks, and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. Talked with Callie Cox about big tech, right? And sort of what we might call the defensive part of technology, things like Microsoft and Apple and NVIDIA versus more of the emerging growth part of technology. In some ways, technology, I don't think is as clear cut as of offense or defense. I would say it's a pretty diverse sector with some offense and defense embedded in there. If you look at a more defensive part of technology, that'd be something like Microsoft. If you look, the chart looks pretty strong. And I think that's one of the telling takeaways I have coming back after a week off and looking at Microsoft and Apple. If you don't know what's going on in the world, I would say the market's probably doing pretty well with Apple and Microsoft making higher highs and higher lows above 2 upward sloping moving averages. That's pretty encouraging. The ratio at the bottom, by the way, is Microsoft versus the ARK Innovation Fund. So MSFT :ARKK. And I'm demonstrating that to show over the last 2 years, if you are long Microsoft and short the ARK Innovation Fund, you get a pretty decent relative return for sure, but also shows that defensive versus offensive parts of technology. When you see that the technology sector is working, it's not the really emerging stuff that's getting it done on a relative basis. It's the more defensive part of technology. Chart number 2, Dollar General. I was running a report for my premium members at Market Misbehavior earlier today. I was scanning for stocks making new 52-week or new 3-month lows. Not many of them, to be honest with you. Dollar General in the staples sector was one that came up to mind. What I wanted to reflect on with this chart, what in this chart is negative, right? What is bearish about this chart? I would argue that this is, from a technical perspective, a clear-cut downtrend. Why is that the case? Well, we have lower highs and lower lows. We're below a downward sloping 50-day moving average. We're below the 200-day moving average as well. The relative strength is trending consistently downwards. The momentum is bearish, but not excessive, right? It's sort of between 30 and 50. So overall, while you can buy a falling knife, while the low about a week ago could end up being the eventual low, I would much rather wait for confirmation, wait for signs that the trend is no longer down and starting to be higher. That's where something like RSI can be a great leading indicator. This is where something like MACD or PPO can be a great confirmational indicator. Finally, when we talk about offense over defense, I want to share with you one of the stocks making new 3-month highs. Pretty defensive one. This is Anheuser-Busch, ticker BUD, obviously a brewing company. You can see that this chart was a rally mode from October, November, December of last year, and then it stabilized. Peaked out around $62 a share and sat there between 58 and 62 for about 4 months. In the last week and a half, we've finally broken above $62 a share and moving higher. When a defensive group like beverages or brewers are moving higher, that means it's a more defensive play that investors are making. We're outperforming on a relative basis, and this also shows how staples are outperforming consumer discretionary very much defense over offense. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close. Special thank you to Callie Cox from eToro, joining us from Charlotte, North Carolina. For StockCharts in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.